Ladies and gentlemen, good morning. Thank you for joining us on this webinar. We will give about 4 more minutes to the other attendees to join us, and we should be able to start our discussion at 10 past 10 a.m. Thank you.
Salma, can you hear me?
Yes, Leah, I can hear you.
I think some attendees are just waiting to be let in. If you can just check.
Well, the webinar setting, they can join as is. They don't really have to be let in. Just a few have come in already.
Yeah, okay.
Yes.
Because there's someone who's telling me they're waiting to be let in. It's like it's hanging somewhere.
Maybe too many people are trying to join at the same time, but I see the numbers increasing here. So let's just give it the next 3 minutes.
All right, thank you.
Thank you. Ladies and gentlemen, good morning once again. I'd like for us to start. You are most welcome to this webinar. My name is Salma Nanshiboneka, and I am the Business Development Manager at the Uganda Securities Exchange. And I'll be your moderator for this discussion. Our topic for the day is the diversification of sources of finance to manufacturers. And I think it's very vital, or the access of financing is very vital and critical for any business. So the Uganda Securities Exchange is proud to champion this discussion today. And our objective with our time is to understand the needs of the manufacturing sector and what solutions can be offered in the capital market space to those particular financing needs. And we will also highlight on how manufacturers can take up these solutions to further develop and enhance their businesses. I'm going to take the opportunity to invite our first speaker for the day. She has served on several boards and steering committees of various companies, including Stanbic Bank Uganda, Hima Cement, Jubilee Life Insurance, Nice House of Plastics, Josephine Dairy, Uganda Batteries Limited, to mention but a few. She is the chairperson of Uganda Manufacturers Association. Ms. Barbara Mulwana, you're most welcome to speak to us. Thank you. Ms. Barbara, I'm going to ask you to unmute. Sorry.
Sorry. So
okay, that's
sorry
fine.
about that.
Okay.
Thank you very much, Salma, and thank you for having me, and thank you for Uganda Security Exchange for this opportunity to have a discussion and conversation around capital and how it relates to manufacturing. So what I'll start off with is just to give a little bit of context on the nature. This is according to you, boss, about the landscape of manufacturers in Uganda. It's estimated that we have about 4,920 factories in Uganda, which contribute about 14% of our GDP. Of those companies, only 4 are listed, and I think everybody knows about them: Cipla, Uganda Clays, BAT, and East African, but I stand to be corrected. Maybe there are more. And there's only one that has a corporate bond, according to us, which is the Madivani Group. Now, of those 4,920, 1% are large manufacturers. That means that they make about $35 million per annum. 7% the medium manufacturers, who make between $200,000 to about $35 million per annum. And then 92% are the SMEs. So anything below 200 million per annum. That's where it's 200,000. Sorry about that, per annum. So as you can see, most of our manufacturers are in the SME sector. Then with that is most of those are actually family owned. And then you have another category, which are government-owned agencies, like NEC. You have UDC, who support certain industries, and so on. Then you have investment clubs. So it's really a mixed bag of manufacturers and their background. However, they all have one need in common, which means that from time to time, we all need to invest for CapEx, and we all need, therefore, money. And I guess what our needs are, what our needs are is always to make sure that we have patient capital and also affordable capital to enable us to expand. Most of the times where we have been getting our money as manufacturers has either been the retained earnings that you pump back, family savings, bank loans, and also investment clubs or SACCOs. So we haven't really gone much onto the security exchange or listing, as much as we would all like to have, like I said, patient capital and cheap capital, affordable capital that we know that we can get from the security exchange. So then the question is why? Why don't we do that? Why don't people go there? So of course there are many. First of all, we know that Uganda Security Exchange is at a level that is international. So therefore a lot of their standards at those international levels. And one of the things that we say as manufacturers, and we would like to hear from Uganda Security Exchanges, how can you modify those standards to fit your particular environment? Like I've mentioned, a lot of our manufacturers are in the SME space, family owned, might not have access to maybe they still have a way to go with regard to governance. They still have a long way to go with regard to just some processes that they haven't put in place. So this is where we then go back and say to Uganda Security Exchange, why don't you go out there and make sure that you can find for us, because we don't have the capabilities to identify certain partners that can come and work with us, because you have that broader mind, who can speak to our own environment, our environment of the SMEs who might be reluctant to give away their shareholding, but where you can talk to them about how to do it. Maybe, I'm not saying lower the bar, but maybe come up with a solution for that. If that's the first solution. If you can't do that, then perhaps the next step is to go and look at certain firms, very few firms, who have got some private equity already within them, because they have obviously jumped probably quite a few hurdles with regard to due diligence, some governance. So they've jumped some hurdles, and there are certain ways. So if you looked at this and say, listen, let's have a long-term, short-term, and medium-term strategy. And then the first one is really going to look at those companies that have private equities, that perhaps we could get those to list now because they speak to our standards. And then we'll get another, I don't know if it's another tier, where we would look at these SMEs who are the majority, who will basically, I'll consider them in certain ways. Well, I'll put them on a certain exchange or something like that. That's just me thinking out of the box. But I think we've also found that these are what other exchanges have been able to do to speak to our particular environment. So I think that's really where we're looking at. And then obviously other areas is areas around incentives, because we know that we're land linked as Uganda. And we know that a lot of people who are going to bring money here are going to think of other places to put their money. So we have to make this environment really, inducive to the people who are going to put money here. And therefore I'm talking about incentives around dividends and capital gains, either removing or lowering the charges that are put on capital gains or dividends. That's another incentive. So basically, in a nutshell, what I'm talking about is, why don't we look at our environment and see what is best for fit for us in Uganda, given where we are and where a lot of our manufacturers are, but also understanding that we do need this capital, we do need to grow, and we do need to move the country. So that is really what I was thinking of. That's what we would like to present. Thank you, Salma.
Ms. Moana, thank you so much. I think one or my key takeaway from everything that you have spoken to is the fact that we need to get local solutions for our local manufacturers. So we need to have solutions that speak to those needs. Without maybe wasting more time, I would want to invite an investment banker, because they do have a deep understanding of what local solutions can be offered to the local manufacturers. So I'm going to invite our next speaker, who is a seasoned investment banker. She has a wealth of experience in research and corporate finance. She is currently the director in the corporate finance division at Dan Blair Investment Bank. Please welcome Mrs. Leah Nyambura Kagumba to speak to us. Leah, you are welcome. And I will be sharing your presentation. Thank you.
Thank you. Thank you, Salma. Thank you for the introduction. And thank you, Barbara, for touching on the areas that you want us to talk about. And more specifically in terms of why We are not listing many companies, many manufacturers, many SMEs. And basically, I think you've touched on a point where you've said we need to look at those that have already done a bit of due diligence and have like P on board and understand perhaps in terms of reporting structures, in terms of the areas to cover, in terms of being having good record, financial record, and perhaps having good investment case that can come on board very fast, but also in terms of thinking about the SMEs and the route that we should be able to follow so that we can unlock interest in bringing them to the USA. I'm just going to cover basically the areas on the financing sources for and options for manufacturers. But in a bit of introduction, Salma, if you can proceed to the next slide. I'd want to first say that as an exchange, and because we are just looking at the sources of funding that the exchange would perhaps offer, the exchange is mandated to create awareness to any issuers or any potential businesses on how they can take advantage of existing markets and the wider regional investors. Because if you're in Uganda, whether you're in Kenya, whether you're in Rwanda, you're in Tanzania, as an investor, you're considered to be a local investor. And so the investor base is quite wide, and there's a lot of money there, because if you look at just Kenya and you look at the pension industry, the fund management industry, you're talking of perhaps a trillion Kenya shillings, which is perhaps 10 billion USD, just Kenya alone. And once you look at Uganda, you would be halfway there. You add Rwanda and Tanzania and the high net worth, the people who understand investments just within the region, then you're looking at perhaps double that amount. So in terms of the options that we'll look at, because businesses do require the financing for their day-to-day running of businesses and for projects, perhaps if you're looking at expansion, if you're looking at modernization, if you're looking at diversification, both for product and perhaps industry, you're looking at acquisitions, then perhaps you don't have enough money, and maybe the only thing you're open to is, and look quicker, would be a bank loan. But then again, you would not be able to compare other financing options, and maybe in terms of even the cost effectiveness of the options that you're looking at. So I'll focus more on the public listings or the IPOs, and basically any other subsequent issuances. If you do an IPO or listing, it would follow the same path. And also the corporate debt, more so on the corporate bond and the listing on Uganda Securities Exchange. And this is for the larger companies. I didn't separate the SME, but they do have a segment, and we can look at it later or on a case-to-case basis if we are able to move the conversation further with perhaps a potential issuer or several of them. If we proceed, I'll do just a brief introduction of who Dan Blair is. We are a regional investment bank in Eastern and Central Africa. We have a license for investment banking, where we deal with corporate finance, which is basically the funding options. The IPOs will fall under these, the rights issues, the listings will fall under these. And then we have advisory, where you do mergers and acquisitions, both for the sell side, if you're looking to sell to a strategic investor, or a buy side, if you're looking for a target to acquire, we'll be able to give you all that advisory. And in this, we do all the structuring, the capital structuring that is required. We do the valuations, we do the model, and then we give you the options on how you can now even merge, or what sort of structure you would fit the business better. We have a brokerage licenses, various, because we are founder members of the Nairobi Securities Exchange, having been in the business since 1954 as broker number 2 here. We are also a founder member of the Uganda Securities Exchange, which was established in 1997, and the Rwanda Securities Exchange, which was established in 2011. We work with partners in Tanzania. We've been able to do deals there as well. but we do only have subsidiaries in Uganda, and rather we are able to use our license to trade, but we don't have an office there. And we deal in brokerage, we deal with both equities and fixed income largely, and derivatives, we've not yet gotten into that. For wealth management, we are a licensed member of the Capital Markets Authority to offer wealth and asset management, and we do offer clients a range of onshore and offshore products. We, in terms of the deals that we've been able to do through the region, just to touch on a brief of them, I know Barbara mentioned just about one corporate issue, which is Medivan Group. But before that, we had been able to advise Stanbic Bank on a bond issue way before they even listed, is it in 2004, before they did an IPO. So we did both transactions, both the bond transaction and the listing or the IPO. We did the IPO for DFCU. We were also placement agent for Standard Chartered, which also did a bond issue. New Vision was a rights issue. Uganda Clays was a rights issue, and then NIC, which is the last that we did in Uganda, as advisor, as transaction advisor and placement agent, which raised about 300 or so million UGX. For Kenya, we've done a lot of deals, and they span across privatizations, and the largest being the Safaricom, the famous Safaricom IPO, which has done well. It didn't do well at the start or immediately after listing, but now it's quite, it's like 6 times the price it listed at. Britam, we did a bond issue. NSC, we did the IPO, the self-listing for Nairobi Stock Securities Exchange. I&M Bank was a reverse takeover of a shell company that was listed in the NSE, and which was smaller than the I&M Bank, so that is why it is a reverse takeover, and then 100% listing of the bank, and then creation of a holding co that is now listed. And the rest, Shelter Africa has always been bond issues, and there have been several of them, about 3 or 4. Cooperative Bank was a listing, Equity Bank was a listing by introduction, which is different from raising funds. So here you just bring the company, and you list it, just the shares, depending on what you agree with the issuer. And then from there, it can be able to do its own capital markets activities, either do a secondary issue, either do a rights issue, either do splits, which it has done. But luckily for Equity Bank, and out of the visibility that it was able to acquire just after listing, it was able to attract a very strong private equity investor or strategic investor, and given quite a chunk of funding for it to be able to conduct its business, such that it was not necessary for it to do any other market activity in terms of raising financing for quite a number of years and up to date. And it has been able to survive with internal generation of fund from just that boost. But the attraction and visibility came from the fact that it was listed. It has gone through disclosures and due diligence. It has gone through restructuring in terms of the governance, in terms of the capital base, in terms of the capacity to absorb more funds. And that way it was able to now have someone who would look at it and see the vision it had and the growth prospects. And they were able to put in 11 billion at the time, which was quite a big amount. For Tanzania, we had been able to do a transaction, a rights issue and an IPO for CRDB Bank, and thereafter valuation. That's just about what we've done in Tanzania. But for Rwanda, we were able to do all the IPOs. We were able to participate all the initial IPOs for local companies, starting with Blarirwa and then Bank of Kigali. The I&M Bank was a privatization by the government, which was ceding about 19%, which is an IPO that we did in 2016, 2017. So if we go now to the financing options, I'll just start briefly on the classification of the sources of funds. And mainly, we do classify largely, generally more from an internal and an external source of financing, because basically you look at the internal sources first before you think of the external sources. And they are very limiting, the internal ones, because you can only have excess cash, which you'd use perhaps to run with your working capital needs. and then retained earnings if you're making any profit. If not, then the owners can always inject equity or new capital, and that is the far that internal sources can go. But then when that is limited, then you look at the external sources. Most corporates and most businesses usually go for bank loans or bank debt, but you can also do corporate debt, and this corporate debt is where now we bring in the exchange, because you can be able to do issuances for corporate bonds or commercial paper. Corporate bonds being more long term, from a year to more than a year to maybe 3 or 7 years, and then commercial banks being more short term, which is the other classification, whereby commercial paper will just run for like a year. Lines of credit will of course come through banks. Overdrafts will of course come through banks. So for the exchange, you can only cover debt issuances or bonds. Or you can also now look at the equity side, which is either equity issue through the public or private equity, where you can even have a strategic investor come on board. And any company that has done the private equity issuance, or has been able to sell to private equity some shares, or has a strategic investor on board, will be at an advantage in terms of coming to the market, because already the capital structure is quite solid, and they are already used to perhaps proper governance, proper disclosures, proper records or financial accounts, and the preparation to now bring them in the market is much, much easier. But it doesn't mean that if you don't have any strategic investor or private equity, and perhaps you're just a family business, that you can't come to the market, because we can be able to come in on board before you even think of coming to the market or raising the money, so long as the timelines allow, and prepare you for about 3, 6, or 9 months, depending on how your books are, how your governance is, how the capital structure is, and what we need to do with all those, so that you're able to now be investor ready, or be an IPO ready, or a listing ready company. And so if you're doing a public equity issue, then that is through an IPO, or you can just list on the USA and immediately now do a public issuance, or a subsequent, maybe a rights issue or a split, for you to be able to perhaps attract more liquidity and attract more investor interest. Then from there, you can be able now to do any other activities, corporate actions. So the other classification I've just mentioned, it's either short term, medium term, which is 1 to 5 years, or long term. Sorry, I think the last line should be long term. And equity shares would be long term, preferential shares would be long term, retained earnings would be long term, debentures would be long term, trade credit factoring would be medium term or short term. Commercial paper is obviously short term. Bank loan can be medium to long term. Lease financing is basically medium, more or less, but it can also be long term. In terms of owners fund, I think I've touched on that. It's either public or borrowed funds, or it can be private equity. So if I go to the next slide, just briefly to touch on the differences in terms of whether you're doing a private equity share issue or a public equity share issue. And in this case, you're either doing an IPO or rights issue, or you're doing a private placement. IPOs, you're offering now to a wider public. Private placements, you have to limit yourself. For us, in terms of regulations, both for USC and Kenya, would be around 100 investors. Of course, there is limited marketing allowed. You can't just shout to the public that you're issuing shares. You have to go one-on-one, perhaps, to the private investors, and then engage with them in terms of the investment case. And then they give you funds from there, and you can decide what to do now after that, in terms of whether you want the shares to trade, which can be with an over-the-counter exchange, which is you can just run as a company, which is now different from you doing a public offer, where you come now to the exchange, you list the shares, and you see yourself listed there, and every day there is a trading on your shares, and there is a price discovery there, and people are able to get in and out of the shares. You can either offer to new members or existing members, or a combination of both. And you can either create new shares or you sell existing shares, so that now there is a sell-off of the current owners, and the money is paid to them. But when you shares, you're looking at raising capital for reinvestment or investment in the companies, either for expansion or whatever the use of proceeds you have defined. Private equity is where you bring on board just perhaps one investor, and this one will come on board either as a strategic investor or just bring in funds, and they will require a bit of involvement and engagement in the business in terms of running the business. They can come and bring in management. They can bring in, they can be represented in the board, and they do bring a lot of credibility because for them, because they want to track their capital, they want to have a company that will be doing disclosures and a company that will be run properly. So they bring governance and management structures that are able to run the company in a way that at least there is visibility of what the capital that they injected is doing, and maybe because for them they are looking at the returns that they'll be able to make. This one is usually for a period of time for most of them, because it will be a fund that will bring in money, and maybe they want to exit within about 5 years. Most of them will be 5 to 7 years, and then that exit plan then can always be, when you're doing bringing in a private equity fund, you should always look at whether you want to exit through the IPO, through the market, the public market, or exit through another PE fund. Most of them prefer the PE fund because it looks like it's easier, but it would be more beneficial if the company has grown to a level where they can make a return, then it means that that company can be sold at a better price if you go through the exchange, because you're selling to the wider public, and they'll be able to visualize the growth and the solid and how the company has been structured, and whether it is a solid investment, and that will be priced in the value that you come with at the time of the IPO, and those are the benefits that you'll be able to gain thereafter, either as an existing owner or as a new investor. But we can also advise on that and tell you how to structure that in terms of the exit plan that you'll have, or the options that you have at the time they're exiting, because most of them will tend to take back the shares to the owners, and by the time they're exiting, perhaps the owner doesn't have the funds to buy them off, and that now will mean maybe they have a new investor on board coming, and maybe you should have more than one option so that at least you're able to cover that. But even the owner can be able to raise money even through the exchange and be able to buy out those investors. So long as you plan perhaps like 6 months ahead before, so that you prepare to have the funds ready by the time the private equity investor is coming out, and then maybe you take it through the market, which is what we would prefer you to do. I think I've touched more on this area in terms of what is the difference between a public IPO offer and a private placement. Basically, it's just that the shareholders will be more in a public IPO than in a private placement, because that is limited to 100 new shareholders. Then the trading platform here will be the exchange. If you have to trade in a private placement, which is not always the case, you have to establish an OTC market, which is an over-the-counter market. But this is always advisable. Most of the companies that are listed used to have this before, because you're able to have a price discovery mechanism beforehand, and that is what prices now whatever you list with when you come to the market. So you can schedule your private equity, private placements thereafter, and then go into the market as a journey to follow. But you can also come directly to the exchange and just list. Then, of course, when you're listed, there's more visibility, there's more brand awareness, because it attracts a lot of media attention. When you're doing an IPO, one of the areas we always have to have, and this is a requirement for the Capital Markets Authority and for approval, is a marketing budget and marketing strategy. And this one will builds the corporate profile, so that you create an investment case that now sells to everybody. Because if you have to sell a product, then you have to sell the company to the investors, and this is within the region, because you sell in Kenya, you sell in Rwanda, you sell in Tanzania, not just in Uganda. And then for private placement, maybe you just select a few, and maybe these will be localized. Maybe it will just be within Uganda. So the public is limited even by regulation. You can't just market. It's actually prohibited by the Capital Markets Authority. In terms of incentives, and I think Barbara was asking what we can do around here. I think this would task the USC to at least follow on so that we can be able to get more benefits, especially on the tax angle, so that you can be able to achieve some preferential tax rates. There are a few, but they keep on changing. The policies changes by the government of the day. We've had tax amnesty in Kenya for quite some time, but unfortunately that changed this year. We've also had tax allowances, which like Equity Bank was able to pay tax of 20% instead of 30% annually for 5 years at the time. That one is no longer there, although now it's harmonized at 25%. And this was scaled down on the basis of the amount of, or the percentage stake that you're able to bring to the market. So if you did over 30% or over 40%, then you are to be charged about 20% tax annually instead of 30%. If you did 30%, then 25%. And if you did anything in between, perhaps 27% or thereabout. But for private placement, you just exist as a normal corporate, you pay normal corporate taxes, and there are no incentives at all. Public offer, this is where most people look like they fear, but this compliance is not such a big thing, because all you need to have is to have an auditor, and also to at least be in compliance with the audit accounting standards. And then that is what you disclose, and any corporate issuance, any corporate governance, new information or changes, any changes in key management, that's all you need to keep on disclosing. And then, of course, the annual AGMs, if there's special AGMs, the dividends, all those disclosures. But they are very straightforward, and it is something that you'll be guided as you prepare to come to the market, and also as we seek the approval from the Capital Markets Authority. For private placement, it's not necessary to perhaps to go to CMA or to apply to CMA or comply with CMA, but we always, if you come through us, because we are also regulated by CMA, we do inform them that we are doing this private transaction, just so that they don't pick it from the market, and so that you also try and set the company in compliance with CMA in case it would want to do a future listing or a future CMA approval. Execution time for IPO processes would take approximately 6 months, but that is when you're already like coming to us and you're already an investor or a public listing ready company. If not, then we will require another 2-3 months to just prepare you before now we launch. We do the actual IPO process, and I'll take you through the IPO process later in my presentation. But the private placement, because all you need to have is to have the investment memorandum, and you don't need to have the process of having the regulator approve and look at your documents and approve, and there's no that back and forth with the regulator. So that cuts off another 2 months, so it takes around 4 months for you to be able to have someone in place. And this is only because for private placement, the investor has to do a due diligence, which takes about 2 months minimum, but it can take more than that. So that's why we have like 4 months, because preparing an information memorandum will not take more than maybe 6 weeks maximum. So in terms of the eligibility criteria, basically for this largely covers more on the bonds, but even for equities, you need to still have these qualities for you to be able to list in any exchange, and even for you to be able to attract any investor, whether it is strategic or just financial investor, whether it's private equity. So first and foremost, you need to have proper financial records, and this also enhances the credit quality. And this just means that your books must be properly prepared by a qualified auditor, and you must have a good track record in terms of profitability and cash flow management, because cash flow management is what to determine, especially if you're issuing a bond or any debt, whether you're able to meet your obligations. So in terms of the capacity to meet or to be able to raise additional capital, we look at the equity side, whether the equity can allow you to be able to raise more debt, whether you are heavy on the equity side or you are heavy on the debt side. If you are heavy on the debt side, then it means you can only issue this much in terms of a bond, and perhaps what you require more is an equity issue, not a debt issue. For bonds, although the USC has no requirement for credit rating to issue corporate bond, it's not in the regulations, neither is it in the capital markets regulations, but for just to prove to investors that you are committed to and you have capacity to meet the cash flow management and liquidity management and debt obligation management, we do propose that you take on credit rating. It just looks at your credit score in terms of the risks of you being over leveraged and you being able to meet your debt or bond obligations, if that is a route you are taking. If you're doing just an equity issue, a credit rating gives the investors more confidence in terms of the kind of management, the kind of company that you are, the kind of commitments that you have, and that also gives you a better risk scoring in terms of lower risks, and that should translate into a better pricing for the within the market or in the market. If you do a private bond, you can do a private corporate bond where you don't have to list and you just sell this to like 100 people. But for us, we prefer you to list because that makes the bond more public. It also prepares you to be able to comply with the disclosures and the regulations of the capital markets. And that way you're also preparing the company to perhaps in future come and do a public IPO. So that is the route we prefer. There are some companies that prefer to follow that route, especially if you are not a company that is well known at the onset, so that at least you're able to also now learn how to be engaging with investors, what are their needs, how do you meet the information gaps, because you have more information as a company and yet they have given you money. So that is usually another route that a company can follow if you have not also done like a private equity route, but it doesn't mean that you can't come directly and do an equity issue. Because of the kind of like now in Kenya we've been facing a bit of some failed corporate bond issues, and that has required most of the investors to be wary of investing with any company that doesn't have perhaps credit rating, but more so that doesn't have a guaranteed corporate issuance if you're doing a debt. If you're doing equity, this is not necessary. But if you're doing a debt, this is usually required so that at least the capital, they are guaranteed that partially the capital that they put in or the money that they put in, they would never lose up to a certain threshold. Of course, for the issue, it comes at a cost. And also that also elongates the timelines for the issuance. Perhaps it will add another 2-3 months depending on who the guarantor is or who is coming on board, because they have to do their own due diligence and then rate the issuance and then be able to offer you now the guarantee. So public profile, because you're now talking to the public once you come to the market, you have to have a very strong brand. So a well-established business with a good public profile will find it easier to attract investors, and this will also be reflected in the pricing than a less known business. So if you are less known, then the higher the premium or the pricing. Premium here is the premium based on the reference rate that you're using, either a government treasury bond, because that is how you price bonds. They will add perhaps, if you add it like 200 for a well-known business, they will perhaps jump to like 350 or 300 to 400 basis point or 3 to 4% above the rate that is reference rate. And based on whether you are a brand. If you're not like a well-known brand, that is. That would also require you to do more roadshows. Roadshows here meaning marketing, more investor engagement, shouting more, and this will also mean that you'll have a larger marketing spend. So in terms of PR, in terms of advertising, you'll have to visually like try and attract a lot of these investors so that you can be able to come to the market. So if you work on just brand strength and being in the public profile, if you're preparing to come on board earlier, way earlier, like the 3 to 6 months, I'm saying pre-IPO, that we can guide you on in terms of what activities or PR activities to be doing for the market or for the wider public to be able to visualize you, whether you're listing in Uganda or you're targeting the region. But the company also, because now the public is coming on board, public requires a lot of disclosures, but these are disclosures and compliance that is guided under the Capital Markets Authority. And like I said, they're not very punitive, and they're not things that you will not have done, because so long as you have good financial records, you have a good brand strength, you have good corporate governance, then these are things you'll be able to tick very easily. The lower the debt, the better for you in terms of the capacity for you to issue, especially debt, but also in terms of equity, because even equity investors are looking at the dividends they can be able to earn, or the returns they can be able to make from the profit that you make as a company. So the more debt you have, because that is an expense that lowers the profitability, then the higher the financial obligation, and perhaps the lower the interest level for investors. So you have a stronger investment case if you have low debt levels. And again, if you have that, a high debt, then consequently you require more roadshows and a larger marketing budget. Stable earnings, again, profitability is key, and it is a requirement for eligibility to list. But then if you still have unstable earnings, you can still do a bit of credit enhancement or guarantee, although now this comes at a cost, and that cost is usually around 1 to 3%. But for investors, especially equity investors, for equity investors, earnings are a key determinant on interest, and perhaps in terms even of the amount they can be able to put into the business. Investors do prefer large issues, both from a distribution point of view and also because of their own internal limitations. By this, I mean some of them who have funds, and they're allowed to, like, say, if they have like $1 million, they're allowed to give you 30% of that, or up to 30% of that. So if you do a very small issue, then their concentration level goes higher, and they will not be able to redistribute to their investors, because they have investors that pull the funds. It would be, the fractions would be too many if it's such a small issue. So that is the only thing where they prefer large issues, and some of them, because of that, will not be able to opt not to participate. So if you can have a project, you can be able to absorb a large amount, that is much better. Say maybe 150 to 100, 300 billion as a minimum. And then that will depend on, now we also guide us in terms of the option that we do, whether we do short term or whether we do long term. So a commercial paper, it can be a small amount, a bond can be quite a large amount. And just to mention that even for large issues, it's more cost effective in terms of the fixed cost relating to the advisory and placement cost and the regulatory process, because those costs do average around 3 to 5% of any issue size. So the larger, the better for you. So the 3% will be because perhaps the issue is large enough, and you can lower this perhaps even to 2% if it is way large. In terms of commitment to higher standards of corporate governance, that is actually a requirement under the regulation, so that at least a third of the board must be non-executive, but they must also have the proper skills to run that business. If it is a business that requires some technical knowledge, then you must have at least perhaps 1 or 2 of the board members being from that industry, or a technical person who can be able to pick things in terms of driving the company, the strategy of the company. So that we can be able to look at once we look at a specific company. And if not, then the board function can always be strengthened. You can always look for skill sets that will fit into what is defined as the proper skills for that business, or what would be the expectations of the authority. And then the board composition, that one can always be tweaked here and there, depending on the people who are available to fill in the positions. For management, it is usually advised or standard practice that the management remains on board for mostly 2 to 3 years without any changes. Although if there has to be a change, then that can be communicated to the authority. But at the time of the application, you have to show that they're experienced and skilled. So that skill set has to be validated for the comfort of both the CMA for approval and the investor in public. And also it creates a better investment case for you. I mean, either to do a private equity or to do a public listing or to do a corporate bond or debt. In terms of process, eligibility, this is for the main board, for the equity listing, and these are just minimums. And these minimums usually are not exempted. You can be exempted from meeting the threshold of, say, the minimum share capital. So if you don't have this already, then this is where we come in and prepare you pre-IPO to be able to raise the share capital to that minimum. And then net assets, we can look at and see whether this can be achieved. If you've not achieved it, but this will require us to work with the current auditors because that can't be exempted. But basically, we also look at the capital structure and whether there is need to increase the authorized shares or do a split so that at least we can have a better pricing that will be more attractive to the investor. And by this, I mean you split because you perhaps want a single digit or just a lower double digit price for you to be able to attract the target investors, especially if you are targeting the masses. If you are targeting the medium investors, maybe a double digit price, and split doesn't change the authorized capital. In terms of value, it only increases the volumes of shares. Share ownership, at least 20% of the shares must be held by not less than 1,000 shares. This is usually the most easy metric to achieve in terms of when you're doing an IPO or when you're doing a listing by introduction, because this one you are selling to the wider public. And like for us, just as Diane Blair, we already have an investor base of over 200,000 investors across the region: Kenya, Uganda, Rwanda. So getting 1,000 shareholders just at the time of the IPO is usually achievable, and that is expected at the time of when you open the offer. So this should not worry you. And to achieve this, you just need to have extensive roadshows and marketing activities that will interest the wider public. Corporate governance, I think I mentioned that. It's at least a third of the directors who should be independent and non-executive. But then you need to have a very strong board function in terms of skill sets and composition, and because you also need to comply with the committees that are under regulations, and the key ones will be the strategy and audit, risk committees, risk and compliance committee, and then the remuneration committee, because those are a must for you to have. So you need to have a number and that has the skill sets that can fit into either of those. So this is a guidance in terms of the skills that you want to look at for your board. In terms of track record, yeah, the issue must be profitable. In terms of profit after tax in at least 3 of the 5 years prior to the date of the offer. Now, for any other, even for the SMEs, these minimums are usually set at a lower threshold. And there are so many, the SMEs will also, there are some SMEs that will be able to tick all the boxes. And for those that don't tick all the boxes, of course, even for the main board, we'll be able, for the bigger companies, we'll be able to work with them and try and see how we can prepare them so that they're able to meet at least these minimums. The rest of them will be easy to tick. In terms of eligibility for a bond issue, again, the minimum is the same. I don't know why they set it as currency points, which is 100,000 currency points, or UGX, and each point is UGX 20,000 before public offering. This is just to be large enough to be able to issue a certain size or absorb a certain size or amount of money or funds. And this has no flexibility in terms of having been exempted by the Capital Markets Authority, so that at least you are a company that they are sure that the cash flow management will be okay, the capacity to absorb the money is okay, the capacity to meet the debt obligation or the bond obligations will be okay. So that is why they have that threshold. And then, of course, the profitability has also to be there, and the accounts must be audited for 3 years and in compliance with the international accounting standards, and the business must be on a going concern basis. The regulations require that you use the current auditor because you have to do a report, an accountant's report based on those audited accounts. So the familiarity with the audited accounts will make it easier for the auditor to be able to look at the regulations and the compliance of each and every area that is set out in the regulations, and that is why that is required, and it also makes it quite fast. In terms of existing loans, again, this is just so that they see whether you've been in breach of any of the loan covenants or whether you're able to meet the current debt obligations, and also to also look at the capacity for you to be able to issue new debt. So this helps in profiling you as an investor from a risk perspective, and that also now means either better pricing, better premium in terms of the bond, the interest rates that you'll be paying. Profitability, yeah, this one I think I also touched on, and you should be at least profitable for at least 2 of the last 3 years preceding the bond issue. And the other one is the debt to equity ratio. It should be less than or equal to 400%. This is also determines or at least helps assess the capacity to borrow and prevent the risk of over-leveraging and perhaps pushing the business to become a more riskier business in terms of meeting the debt obligations. This is also tied to the operating cash flow and cover ratio. The ratio should be greater than 40%. Again, is the same issue of being able capacity to meet liquidity and the debt obligations going forward, and also so that at least you're also not over leveraged and overstretched, such that now the business collapses in the middle of the bond tenor or term before maturity. In terms of the process, pre-issuance, what you require to do is to look at the approvals that the company should have. If say like you're a manufacturing company and perhaps you are regulated, I don't know whether you have any manufacturing company there that is regulated by anyone, then that regulator has to approve before at this level. But most manufacturers don't have regulators, so you'll just require board approval and the shareholders approval, and then you need to select some advisors that needs to come on board, which we can guide you via the transaction advisor. But basically, the transaction advisor has to come on board at this time, and then that will assess the eligibility compliance for you. But these are just the prerequisites so that now you know the financing options to go for, because the advisor will be able to look at your capacity to borrow and the capacity to meet the obligations, and then the qualities, the eligibility qualities of good track record, good profitability, governance, management, debt levels, financial performance. They'll be able to look at that and then guide you accordingly in terms of where you tick and where you fit, and where you should start. So from there, once you select the advisors, the transaction advisor will be able to guide you in terms of the other advisors that you require. And then the first thing that they do is do a due diligence, which is more of financial due diligence and legal due diligence. Financial due diligence being done by the auditor in terms of looking now at everything, including the covenants, the profitability, the capacity, the capital structure, and in depth, just telling us whether you can be able to issue and whether we should be able to take you to the public, and whether you're fit to get there and get the approval of the regulators to issue to the public. But even for private equity, they still have to go through this process. Legal is to look at all the legal issues, the articles and memorandum, whether they allow for free trading of shares, free transferability of shares, the legal litigations that are already in place, and possible ones that can at least affect the operations of the business, the liquidity of the business, and any other legal matters that needs to be handled, including the increase in authorized shares and how to register those shares with the registrar of companies, and any other issue that is legally, even in terms of disclosure, in terms of ownership structures, in terms of the governance, corporate governance structures, they look at all that. So that takes about 2 months, but that can run concurrently with the next process, which is the preparation of the offer documents. Both of these reports from the financial advisors and from the legal advisors will form part of this offer document. But there are also some other areas that don't cover this, and this is where now the transaction advisors prepares, and also they do the valuation, so that because the information memorandum should have, and this is what we call the IM, should have the price at the time of coming to the market. And then separately, they do an application form, because this is where now people put in the application of how many shares they want to do or how much they want to invest, and give their details as in form of a form. And this is what now is processed. All these documents have to now to be taken to the CMA for approval. And once the CMA, Capital Markets Authority, approves, that is when now we seek for the USC, or the securities approval, so that they can now allow the listing or accept the issuer to be listed on the exchange for trading. So once you get the approvals, then you require about a week or so to print and then distribute the information memorandum and forms to the investors. At this time, we also do the roadshow. We prepare now to start doing the roadshows. And then you open the offer, which is the last stage, which we call placement. And here you do now everything. You do PR that supports the offer. You do the roadshows that support the offer, which is basically just investor engagement, whether it is one-on-one, whether it is radio advertisement, media advertisement, print advertisement. And this is done during the offer period. There is usually some activities for the launch of the offer. You can either have a breakfast to just launch. You can have PR activities around it, or marketing activities around it. You can perhaps even invite a president, so that it shouts that this is a launch, depending on whether it is for the masses, or you can invite perhaps a key figure or an influencer that can come and perhaps from a PR or a marketing point of view, give it more weight. Then you open it for maybe around 30 days before now you close. Close is to say this is the end of the applications, and this is the end of receiving of funds. But then there is another process, which is we take to a registrar who receives the forms, the application forms, and processes to say Leah has applied for this number of shares. This is the amount of money she has put in. Can we be able to allot? Is the issue in totality oversubscribed or undersubscribed? If it is oversubscribed, what we do? If it is undersubscribed, it's more straightforward, because you allot everything 100% of what they have applied for. Do we refund for oversubscription, and how much do we refund? Do we prorate so that we allot based on perhaps a certain formula, or what do we do? So there is usually a fiscal agent there that usually do that process, and these we guide as a transaction advisors. Then after you've allotted, then you have gotten the approval. Of course, the approval is from the board first. Then you take it to the Capital Markets Authority, so that they can allow you now to announce the results. And if there are any refunds, then that is when you do the refunds. But for this would take in total would be about 6 months. But if you have to do guarantee and credit rating process, because they can run concurrently, but those will take some take 2 months, some take 3 months. There are those that take 6 months. So we just need to work with the company at the time of preparing to come to the market, for us to understand how long that will take and what sort of guarantee or credit rating you require. In terms of now advisors, as I finish, that are required in the transaction, just briefly, the transaction advisor, which is the role we normally play mainly. This one is usually engage with the issuer pre and usually mostly pre the issue, and that's when they should come on board, so that at least you're able to assist in the recruitment of the other advisors, but also to guide in terms of the capital structure and the form of financing and the most optimal financing option that you should go with. So you prepare a work plan that you'll be able to put in the activities of each and every of the advisors and run the process that I've just covered. And then from there, you now do the offer preparation, and then you manage the work plan throughout the transaction up to when you now close. So you will engage with all the advisors, you will engage with all the regulators, and you will seek all the approvals on behalf of the issuer, and work hand in hand with them in terms of even preparing the investor engagement, the investor presentations, and even scheduling the meetings. But then for the meetings, of course, the management and the company itself has to sell its case to the investors, and that is what they would prefer. But the transaction advisor will walk the journey with you, and they'll be present, and they'll be able to answer the queries that relate to the transaction. But then just because of the way they are structured, the license to advise is different from the license to take a company to the market. So that is why you require a sponsoring broker or a placing agent. And this for the Uganda Securities Exchange has to be licensed by CMA and has to be a member of the USC, or has to be working with the USC. There has to be a member for them to be able to take you to the exchange. So that is usually called a sponsoring broker, and their role is to market the transaction and the issue, and develop a sales strategy that is going to meet all the threshold and the requirements, with the main goal and or objective being to raise the funds that you require and reach the target of investors that you want. So, and after that, after the closure of the transaction, then they give a placement report. Legal counsel is what I had talked about in terms of developing a legal opinion. They do the legal due diligence and cover all the aspects and requirements in terms of disclosure for inclusion in the prospectus, and they also advise in terms of the future disclosures that the regulator will require from time to time, and what is material that will require you perhaps to even announce on the newspapers, and what is immaterial. The other one will be the reporting accountant, and the reporting accountant just looks at the audited accounts and prepares that in terms of ticking the boxes in terms of the readiness of the issuer from a financial perspective to come to the market or to go to investors. The other one is the registrar or the fiscal agent, and this one usually processes the applications and the allotment, and then from there periodically, of course, starts off with after allotment you create a register of investors, and then periodically, because it will be trading, then they're the ones who are tasked to be updating that register, and they do normally give a monthly report to the Capital Markets Authority. They are also used by the issuer to distribute dividends once it's computed. They can even compute and distribute and do the payment. So that is their main role. So you have the registrar. Once you choose a registrar, you have them for life, but you can change them over time. You don't have to be tied to one for life, but at least you have to have a registrar going forward for the period you are listed. For bonds, they also do computation and distribution of the coupon or the principal payment, coupon being the interest payments, the periodic interest payments. They also keep the register as well. Receiving bank is just a bank that is appointed to receive all the proceeds, because it's required that the account is separate from any company account where the funds sit until the issue is closed. That is when the money is now transferred to the issuer, and that is when you say now you have closed or you have money. Because otherwise, if a transaction fails, then the money should be able to be returned to the investors from that receiving bank. Then PR agents is basically for media and market planning and marketing the transaction when necessary. For if you're doing to the public, this is very necessary. If you're doing a private issue, then you don't have to do that. Then no trustee is just for bond issues only, and this is to act on behalf of bondholders. They represent the interest of bondholders in terms of disclosures that are required, in terms of any terms and conditions, whether those are being met by the issuer over the period of the bond issue. So that is their main role. Thank you very much. I think that's the end of my presentation, and I can take questions. I can see one question. What was the impact of, before I hand you over to you, Salma, what was the impact of the discounted corporation tax rate offered to Equity Bank in the past on general within the Kenyan business community? The impact was quite huge, because at least once you at least have 10% guaranteed for 5 years of money that you would have paid as tax. So that money you can either reinvest or you can redistribute as dividends. They opted to reinvest the money, but at least they were able to also pay dividends out of it. So a portion of it went to dividends. So that was the main impact. of the business. So you have ability to grow more because at least you have an additional 10% or a certain percentage of money coming back to you or not being remitted to the regulation, to the tax regulator. The next one was, what is the resolution mechanism for failed troubled corporate bond issues in Kenya? Unfortunately, we had this problem, and basically because most corporate issues are unsecured. And that has been the way they had been issued, and it was allowed even when they are listed. And unfortunately for those businesses, they went under, or they were liquidated. And to some extent, the liquidation proceeds were not enough to reach even some of those investors. But currently now, the resolution mechanism is around guarantee. So you can't do an issue here without guarantee. And so that at least if there is any failure, at least the investor money doesn't, there's a portion that perhaps is covered by the guarantor that at least can come back to you. And also rated. You have to also be rated, not just being listed, unfortunately. And this is from the issuer's perspective, it is more expensive. It becomes more expensive because you have to pay the guarantee fee, you have to pay for the credit rating. Thank you very much. Salma, back to you.
Thank you, Leah. Maybe before you, there's one more question under chat.
Okay,
I'll just read it out from Julius Businge. Apart from the financing options that you have shared, what unique state interventions would you recommend to lower commercial lenders to cut interest rates, currently averaging at about 18% per annum in a free economy like ours?
wow.
Give a comment on
what
that.
we've seen, what we've seen here is the state doing some rate caps or capping of rates, but that didn't work well for in terms of the private credit side, because it discouraged a lot of people from borrowing, or because the risk profiling of the money or the borrowers was much more hard work for banks to do. So they stopped lending because they could be able to perhaps raise the money from government securities, which is considered a bit risk-free, at around almost the same return, because you could give government money and get a coupon of 12.5%, 13%, and then the rates were capped to like 14%. But you can lower the threshold for cash ratio or interest rates, so that you can be able to bring down the interest rates, because the benchmark has to be the government borrowing. That is usually the instruments. The government instruments are the benchmark from which now you add a premium to the pricing for you to be able to price a bond. You can push, I don't know, from the USC angle and perhaps even the Capital Markets Authority, and see what incentives can be done, maybe even from a guarantee point of view. Perhaps they can even take on some cost of the guarantee. They can take on some cost of the credit rating off from the issuer, so that you're able to reduce the burden. But if the rates are, commercial lending rates are much higher than if you came to the market, I think even 18% would be much easier for an issuer to take on than to just take a corporate debt or a commercial loan. But that's something perhaps the USC can take on, and perhaps together with the Association for Manufacturers, and lobby for them to be able to reduce this, so that the cost for the borrowing or through the capital market is much easier for the issuers.
Okay, thank you very much, Leah, for the comprehensive presentation, and also for dealing with those questions that had come through from our attendees. I'd like to just give the next 5 minutes. I do apologize, we have overshot our time, but I'd just like to give the next 5 minutes to our next speaker to just take us through their presentation on behalf of the Uganda Securities Exchange. And then we can take on any more questions before bringing this to a close. Okay, so just to introduce our next speaker, she is a governess professional and advocate of the High Court with experience in corporate, commercial, in-house legal practice. She has provided legal advisory on matters ranging from regulatory compliance, product development, legal risk management, and corporate governance, among others. And she is currently the legal and compliance manager at the Uganda Securities Exchange. She is representing the CEO of the Uganda Securities Exchange. Please welcome Mrs. Alison Kwikiriza Serichacha. Alison, you're welcome. I'm going to put up your presentation shortly. Thank you.
Thank you, Selma, and good morning to Barbara and Leah. Thank you for those detailed insights. And to the participants who are with us online and those that are following via live stream on Facebook, good morning, and thank you for your time. I'm privileged to share with you on this topic on behalf of the CEO of the exchange, who is unfortunately not able to be with us this morning. I think a great deal of what he had prepared has actually been extensively articulated by the previous speakers. Perhaps this is one of the few times where coming last comes in handy. But just for purposes of this discussion, I'll just like to share a few highlights from the perspective of the exchange, what value we actually bring to the table for the manufacturing community in Uganda, specifically in terms of bridging the capital gaps. I think as Leah and Barbara did mention, businesses need capital for business growth expansion, to execute their innovations and strategy. And I guess the question of the day then becomes, how do we meet their financing needs? And I guess which speaks to the selected topic of the day, diversifying financing resources for manufacturers. Just to quickly scan through the available capital raising instruments that we do have at the exchange. We have equity, and so far we have 17 companies that are listed on the exchange and that have been able to raise capital through equity instruments. We have debt, a total of 65 treasury and corporate bonds combined presently. And our regulatory framework, both at the Capital Markets Authority and at the exchange, does accommodate real estate investment trusts, exchange traded funds, and commercial paper, although these have not been tapped into by our different sectors. Looking at the capital raised on the exchange, Salma, if you could go to the next slide. We're talking about capital in excess of 2.2 trillion raised to date, and you can see the breakdown there. For initial public offers, we've had about 1.4 trillion. We've had secondary market offers, there's DFCU, we had Umeme. Combined, we're able to facilitate over 500 billion capital raised. And we've had a couple of corporate bonds. Currently, we do have Kakira and African Development Bank, but over time, we've had a number of bonds listed. I think Leah spoke to this. We've had Housing Finance, we've had Stanbic. So we do have a couple of these entities that have actually utilized the market to be able to meet their financing needs. In terms of the available market segments, and I'll just quickly run through them because Leah's presentation on the different requirements for listing was quite comprehensive. We have the main investment market segment, which is the largest platform for raising capital at the exchange through equity instruments. And of course, this comes with the ability to generate unlimited financing through a wide pool of investors. Typically, this segment will attract larger businesses, because we saw that the minimum threshold for shareholding is about 1 billion, and for net assets is 2 billion. So the businesses that will ordinarily be listed on or apply to be listed on this segment are more or less the larger businesses. And the other segment that we have is the growth enterprise market segment. Now, it's interesting that in her presentation, Barbara mentioned the need to develop local solutions for the SME sector, for the Ugandan businesses. And this particular segment is unique in the sense that it seeks to accommodate the growing SME market in Uganda, and specifically acknowledging that there are a couple of businesses that are good businesses, but may not necessarily meet the capital and net asset requirements that are required under the main investment market segment. So they can be able to meet their financing needs, their capital needs through the growth enterprise market segment. And the other segment that we have is the fixed income securities market segment. Here, this is where entities are able to raise capital through debt financing, corporate bonds. And this is also where the government treasuries and bills are actually listed on the exchange. I will not go into the listing requirements. I believe Leah exhaustively spoke to that. So just really to run to the million-dollar question. So why should manufacturers look at the securities market to meet their financing needs? The first and most obvious is that you have the opportunity to access capital and future financing opportunities. Now, whereas we recognize that there are a couple of different options for financing, but I think the critical issue is to look at capital markets and of course, specifically the securities market as a complementary source of external funding, especially within the larger financing ecosystem. And what is critical is in terms of selecting a financing model for a business, we always encourage businesses to take into consideration the business specific needs as well as the stage of the business life cycle, because this is what will really inform how you select your financing model. We've had the previous speakers talk about patient capital that enables you to expand to achieve business growth. And more often than not, we've found that growth-oriented businesses and growth-oriented SMEs are actually most suited for accessing capital through the stock market, because it is patient capital, it is affordable, and it will enable you to achieve those long-term business growth plans that you have in place to enable you grow your business and derive the sort of value that you're looking for. Definitely, we do have an enhanced market value that comes with utilizing the securities market. I think the previous speakers hinted on the price discovery mechanisms that are able to highlight business growth in terms of growth of your share value, and the transparency that supports that kind of growth. And this has really manifested in a number of businesses that have accessed capital through the securities exchange, with the likes of BAT, Stanbic, who from the time we were going through the privatization process, which was really mandated by regulation, but you can see the kind of growth and value that they've been able to achieve through utilizing the capital markets to actually meet their financing needs at the time. I think I'll speak to increased brand equity as well. Obviously, with the stock market, we do have greater expectations in terms of the transparency and disclosure standards that are set. So there is a lot of confidence that you're able to give out to whether it is your investors or the general public in terms of your business model, your business plans, and the ability of the business to actually execute the plans that it is projecting out to the general population, because there is that comfort that there is a higher standard of transparency, a higher standard of preparation of your financial statements, a higher standard of selecting the people that set the tone at the top that will invariably support business growth and a successful execution of a business strategy. Of course, you have access to a wide pool of institutional and professional investors that are able to add value to your business. And I think Leah mentioned the growing pool of investors across East Africa, in Kenya, in Rwanda, and the Tanzanian market, all of which is you're able to be exposed to these particular investors, whether they be institutional or retail investors that can support your capital needs at the time when you do decide to either do an IPO or issue a corporate bond. I think just in closing, I'll just like to pick out two particular issues that kept on coming up during the discussion. One was to do with the issue of incentives and how particularly tax incentives can be enhanced, especially within the Ugandan setting, to make the market more attractive. We hear you, and I think over the last 2 or 3 years, we have been vigorously engaging with the Ministry of Finance. We have engaged with the Uganda Revenue Authority and in collaboration with the Capital Markets Authority to see how we can harmonize issues of capital gains tax, issues of tax amnesties for those businesses that declare that they actually would like to list on the exchange, with the hope that given the disclosure requirements and the financial reporting standards that they are held to, they'll be able to comply going forward. We've also spoken on the issue of harmonizing the withholding tax regimes across the different East African countries so that we can have an attractive regime for investors as well. So these are areas which are work in progress and which we have been collaborating with the various responsible parties, especially within government, the policymakers within government, to see how best this can be achieved. The other issue I'd like to speak to is around generally ease of access to the market and how we can find local solutions for the businesses that would like to utilize the securities market. Now, the first that I've already alluded to is the creation of the growth enterprise market segment, which really accommodates all those, the outliers that would not be able to meet the requirements that are prescribed for the main market segment, but also that at a stage that would not necessarily require the detailed preparation that would ordinarily be expected for the main market segment. But more importantly, one of the things that we've been looking at is our rules framework in collaboration, of course, with the primary regulator to see what pain points we can actually pick out and either enhance or flex so that companies that would ordinarily be prohibited by those few hindrances that can actually be adjusted are able to be accommodated within the meaning of our regulatory framework to be able to come to the market and access capital. Salma, I don't know if there is any other slide. So yes, that is it on my part. There's a question that came through on the chat that I may respond to. I think someone was asking around partnerships with other stock exchanges so that we can have dual listings. Just a quick response to that. I think one of the things that we've done, and that is a valid proposal suggestion that you raise. I'm not sure who sent through the question. However, we do, you'll note that out of the 17 companies that are listed on the stock exchange, we do have 8 of those that are cross-listed from the Nairobi Stock Exchange. And this has been achieved through a partnership with the Nairobi Stock Exchange. Within the East African region, we have the East African Securities Exchange Association, which includes the Uganda Stock Exchange, Nairobi Stock Exchange. We have the DSC, Dar es Salaam Stock Exchange, and the Rwanda Stock Exchange. And really, it is a collaborative sort of association that looks towards improving the collaboration across the border with between the different exchanges, of course, including the creating a favorable opportunities for dual listing, but also generally improving the awareness of the benefits of the securities markets and conducting investor education on the different activities that take place at the various stock exchanges so that we can see growth across the board. Salma, I'll hand back to you.
Thank you, Alison. Before I let you go, I think there's another question that has come through from Bernard Usulwa to you. What is the considered uniform withholding tax rate for all securities exchanges in East Africa? Do you have a comment on that?
Sorry, Salma, can you just say that again?
There's a question that has just come in from Bernard Busulwa to you, and what is the considered uniform withholding tax rate for all securities exchanges in East Africa? Do you have a comment on that?
So there is, I'm not sure if I get the question correctly. There is no uniform withholding tax rate for the exchanges across the Africa, especially in terms of the dividends. But what we do know is that the Ugandan withholding tax regime, which is at about 15%, is slightly higher than our Kenyan counterparts, for instance, who have 10%, if I'm not mistaken. Leah, you'll confirm this. So what we're trying to achieve is either matching, most likely matching this particular tax regime, so that we are, from an investment perspective, we are equally competitive.
Yes, Alison, I can confirm that ours is 10%.
Thank you.
Yeah, for foreign, and for dividends, 5% for locals.
Okay. Thank you very much, Alison. Leah, just in closing, there is an open question for you under Q&A, still from Bernard Busulwa. What is the resolution mechanism for failed or troubled corporate bond issuers in Kenya? Maybe you can just give a comment on that.
Oh, I had covered it. I don't know whether he was able to hear, but what I was just saying is, unfortunately, the ones that have failed, that one, because the bonds were unsecured, they were not able to recover the money for investors. But currently, if you need to issue any other corporate debt, it has to be guaranteed so that at least the capital, or partially the capital, is secured. And of course, now that increases the cost to the issuer.
Okay, thank you very much to all of our participants. I think the most important thing to cover after this comprehensive discussion is, of course, the what next and what are our next steps and how can manufacturers do take advantage of all the products that we have been taken through this morning. I think in the chat for our attendees, in the chat space, our contacts, particularly my email, has been shared with under the chat tab, and feel free to reach out to us. We are able to connect you to various trading participants, various advisors who will guide you in the what next step, especially as you look to take advantage of raising capital and long-term financing through the Uganda Securities Exchange. I'd like to bring this to a close. I'd like to thank all of our participants. Thank you for the questions that have been asked. Some of the questions, especially to Uganda Manufacturers Association, have not been answered in this platform. However, we'll personally reach out to the people who ask those questions. Uma will personally reach out to you to make sure that those inquiries are addressed. We thank you. Thank you to our panelists. We had an all ladies panelists this morning. Thank you, Leah. Thank you, Barbara. Thank you, Alison. And we would like to thank all of the participants for engaging with us this morning. This is not the last time you will have such engagements. We'll continue to engage with the general public with the aim of increasing awareness on product offering to ensure that we are providing the right financing solutions in line with the various needs to further grow your businesses and also enhance growth of the Ugandan economy. Thank you very much. I'd like to bring this to a close. Have a good day.
Good day.